Hello there. Thank you for coming back to learn about Chapter 8 in finance here in Real Estate Principles. This is a fascinating chapter, and I find that for most students, this is an area that everybody knows about, but they don't really know. And almost everybody has to get a loan when buying real estate. Uh, so it becomes a very, very important concept, and most people just know that surface level information. So hopefully this chapter and this lecture will not only help you understand the concepts more, but also give you some real life experience, some real life perspective that will help you in your business, that will help you personally when you're out there looking for a loan or wanting to buy real estate, or even planning ahead to buy real estate in a couple of years from now. Because if all of your ducks aren't in a row when it comes time to get that loan, the bank might just say no, and then you're going to be out of luck. So first off, why do we need loans? Why in real estate do we have to get a loan? We don't have to, but especially here in Southern California, where we are here mid 2021, and prices are at all-time record highs. And I think the average price in Orange County for a single family residence, somewhere around 900, I think, which is just insane. You know what's crazy? I just found I'm doing some demo in my house to redo a bathroom. And when I'm opening up one of the walls, I found this newspaper shoved in between the studs in the wall. And I pull it out and I put it aside. And as the demo went on, I kind of forgot about it. I just came across it today, and it's from 1977, which also happens to be my birth year. I just aged myself. But so 43 years ago, this newspaper was shoved into the wall, and it's the real estate section. I'll have to scan it and send it out. 4-bedroom homes in Tustin and Orange County and Orange for $70,000, something insane. We have to get loans typically because it's really difficult to save up $900,000 to buy a property all cash. And especially if it's your first home. Now, if you've owned homes or your family has owned homes for decades or generations, then maybe there's that wealth that accumulates over time. And there's property that you hold on to or keep for long periods of time, a family or a trust or something, if not you personally. But if it's your first home, you don't have probably an extra $1 million sitting in your checking account waiting to buy property, right? So we have to get a loan to borrow that. There's also a business concept called leverage. And some economists or bankers actually suggest that it's better to use leverage, to use somebody else's money instead of using your own. Because for all those years, you might try to save money to get to that $1 million property. Well, in 10, 20 years, it's going to be worth even more, right? Theoretically. And over that 20 years, you would have lost on that gain. So especially in today's rates that are at maybe even 2%, 3% for 30 years to buy property, you still have to have a down payment. You still have to have credit. We'll talk about some of that stuff tonight. But the idea that you can borrow that money for only 3%, I mean, that's like buying a car rate for real estate. I mean, it's just crazy low, historic lows on those rates right now. So I'm going to go over a couple terms, go over a couple concepts, super informative chapter 8 lecture here. So first off, let's cover a term that comes up in the chapter called the promissory note. Spelling this right? 2 S's. Promissory note. I'm going to underline a section here, the promise. The promissory note is something that you sign every time you borrow money. This could be for buying a car. This could be for borrowing money for school loan. This could be buying real estate. At any point in time, if you borrow money, excuse me, getting a little late. As you borrow money, you sign this note that is a promise to repay, the promissory note. the promise to repay. Now in real estate, this creates something called a lien, which means somebody else has an interest in your property because you owe them money. So the bank lends you money. Until that loan is paid off, that bank has an interest in your property. If you can't make payments, the bank can take that property back. So I want to also show that when you sign this promissory note, talking more specifically about real estate now, there are certain things that are public information. There are certain things that are not public information about this lien, this promissory note that you sign with the bank. What is not public are certain details of the loan, like your interest rate. I'm going to abbreviate, sorry. Your interest rate that you get for your loan is not published. So nobody else knows if you have a 2%, a 5%, a 12% loan on your property. That's between you and the bank. The other terms that come into play with that loan, for example, is it adjustable? Is it a fixed rate for 30 years? Is it a 15-year loan? All of those different terms and details of the loan are not published publicly. Also, this term, you'll come across it, called subordination. Whether or not your loan can be subordinated is also not public information. This is between you and the bank. Now, what is public? The fact that this lien, this interest that somebody else has in your property because you owe them money, is public, is to show and have some sort of public record of who you owe money to. So the loan you get money from first is called your first trust deed. Then you get a second, or you get a home equity line of credit. This becomes a second trust deed, second lien. If you borrow money from a family member and you want to give them some sort of security so that if you don't pay them back, they have an interest in your property, you can sign a document and give them a third trust deed. And they go in order that they're recorded. Excuse me. This public information shows the order that they're recorded. So it shows if it's Bank of America or it's your credit union or whoever else comes down that line. It also is published the date, the amount that you started with. So if this loan is 10 years old, you look at the date and you can see public record. Oh, they got this loan 10 years ago. You don't know how much they owe today. You can see that they borrowed $500 10 years ago. We don't know what their rate was or how often they're making payments or how much those payments are. We have no idea. So, but the date, the amount that you started, and the name of that lien holder are all public information. So here's an idea. When you sign this document that says, yes, bank, I promise to pay you back at these terms, at this interest rate for this length of time. All that information is between you and the bank, but it is public when you get it and who's giving you this money. Now, again, why do we get this loan? We usually need it to buy real estate, right? Because we don't save up enough money. But to get this money from a bank, there is a cost. It's called the cost of credit. Now, the cost of credit, when you use your credit card to buy something, I saw something today. It was some statement that said, I don't have a balance on it. It said it was 29.6% interest. What? So if I go spend $100 and I don't pay off that $100, I'm going to have to pay them $30 to let me borrow that $100. Credit card interest rates are ridiculous. We're going to talk a little bit about that tonight too, about credit and borrowability. Yeah, it's a good chapter. So what is this cost of credit? I'm borrowing money from the bank. The bank is letting me use their money. What do I have to pay for? So there's something called origination fees. Now, this is not the first thing that your lender tells you about when you talk to them on the phone. They're going to tell you the interest rate. That's normal. But the origination fees is another thing that you may have to pay just to get that loan. There's a term called points. So your lender might say, hey, I can get you a 3% loan fixed for 30 years, but it's going to cost you 1 point. That point is 1%. So if we're talking about a loan of $500,000, that 1 point in origination fee means that you're going to have to pay $5,000. Yeah, you heard me right. Or if you're going to borrow 500 grand and you're going to pay an origination fee of 1.5 grand, maybe you don't pay it out of pocket, but you borrow an extra 5 grand. So you're actually borrowing 55 grand to pay that fee. Sounds kind of crazy, right? Because you can actually borrow the money to help you get the loan that you're borrowing money for. Another cost of credit that you could come up with, or that you could see in the process, is called a discount point. This point is also, right, point means percent of the loan amount. So let's say we're getting that $500,000 loan, and the lender says, I've got $500,000 loan at your credit score, right? With the money that you make and the debt level that you have, you can borrow your $500,000 at 4%. Or I can get you a 3.5% if you pay 2 discount points. So this would be a loan of 500K plus 2 discount points, right? Plus $10,000 that you're going to have to borrow in addition to your 500 or pay out of pocket to get the lower rate. So here's 400. I'm just using just general round numbers here, right? I'm making this stuff up, but here's 500,000 at 4%, or you pay this 10 grand and pay 3.5%. Now, is it worth it? Well, I don't know. You'll have to do that math. If we're at 3.5% instead of 4, you know, how does that affect my payment? Is that payment difference like $200 a month, $300 a month? Well, how long is it going to take for me to pay off that 10 grand, that extra 10 grand? Well, if it's $200 a month difference divided by 10,000, right? Quick math. It'll be several years. Maybe not worth it. Maybe if you plan to get this loan, I have a friend. This is one of those transactions you hear about. You're like, there's no way you're going to be able to close this loan. It's way too good to be true. And he was able to do it. He found this special program where he was able to borrow money to buy the property, but there was no limit to the discount points. And so what he ended up doing was that he paid up front. I think he paid like 20 grand for this loan, right? Out of pocket. He paid that much money just to get the loan. That was the cost for the credit. But that money bought down his interest rate to 0. What? So he has on his home, he has a 0% interest for 30 years. So he's only paying principal. So his goal, his plan is to never refinance that loan, right? Once you refinance that loan, you're going to have to pay whatever your new term is with your new lender. So since he had to pay so much money out of pocket up front, it was worth it to him. So because he planned to keep this loan basically till it's paid off. Another cost of credit, and this one comes with every loan, is your interest rate. Now, of course, you're going to have to pay the bank for that money, right? Right now, again, we're at historic lows. You can still get loans to buy homes in the 3s, low 3s, maybe even high 2s if you're talking about a 15-year loan, or maybe you have amazing credit, or you have a really low loan to value. We'll talk about some more of these terms in a minute. There's interest. Yeah, I'll show you. So real estate loans are, when you borrow money on a real estate loan, it's not like a credit card. It's not like actually car loans kind of do something similar, but it's called an amortization. Amortization schedule. We're going to look up an amortization calculation. All right. Oh my gosh, I just realized that we weren't even sharing screen this whole time. Let me go ahead, jump to the amortization calculator, and then I'll come back to my notes and do a quick recap before we move on. Amortization calculator. So an amortization calculator, let's just use some round numbers, 500,000 for 30 years at, we'll say 3.5%. That gives us a monthly payment of $2,245. Let's see. You can look at this amortization schedule and get a picture of what this looks like. So you can see from month number 1, July 2021, our payment is the same amount all the way through the life of the loan, except for the last payment. In this loan payment, the vast majority of that money is going into interest. Now, because our rate that I just put in here was only 3.5%, right? We're talking about almost double-ish. Most of the money, though, goes into interest. Notice that over time, the amount that you pay into interest goes down every month. So that when you fast forward 30 years, I think it's around year 7, it flips. See the amount that you pay over time, the amount you pay into principal goes up. So we're 2021, what was 7 years puts us at 2028. Yeah, it's about break even, no, about equal payments of principal and interest. I'm just doing this with you because I'm interested. Sorry to make you dizzy if I'm scrolling too quickly here. Over the years, 21 to 32, that's 11 years. There, and it flips. So about 10 years. Yeah, around here. So you're saying that for the first 10 years of this 30-year loan, you're paying more money into interest, even though you're only paying 3.5%. You're paying more money into interest than you are into principal, because the bank knows on average, homeowners refinance or sell about every 7 years. So they want to get as much interest out of you as possible on the front end. And that's why they use an amortization schedule, an amortization calculation. Just for kicks. So we're looking at this about double principal is about half of the interest payment off the stock. Just to give you a little bit of perspective, let's just say that we're looking at rates from 3 years ago. Look at that difference. Principal payment's only $547, and you're paying almost 4 times that amount in interest, just with a 2% increase in that interest rate. Isn't that interesting? The payment went up about $600, but with that change, even more interest up front. Now, here's one of the big benefits of home ownership. When you own property, this interest rate, this higher payment that you're paying every month, you get to write off this interest every year on your taxes. I'm not a tax preparer. I'm not a licensed CPA, but we get to write off that interest against your taxes. Interest and property taxes, which we aren't talking about tonight. But all right, so that's what an amortization calculation looks like. You can look this up on any website, pretty easy to find there. So the bank uses this. And let me draw another quick picture for you when I actually do share here. Sorry for not sharing before now. We'll catch up on these notes here. So what happens in this amortization, also, we just saw the numbers. What happens was the money that you pay into interest over time goes down. The money you pay into principal over time goes up until the loan is paid off. Notice how I'm saying this. The money that you pay into interest goes down over time. I'm not asking you what your principal balance is. I'm asking you about the money that you're paying into that amortization. One last note here, and then I'll do a quick recap. When we're talking about the cost of credit in loans, right? That's what we're talking about here. We talked about the origination fees, and discount points are both points, which mean 1% of the loan amount. The origination fee may just be a blanket fee that lender charges. Some lenders may say we don't charge an origination fee. Some brokers, if you're using a lending broker, and they have access to multiple banks, sometimes those brokers get paid a fee from the bank, and they don't require it from the actual borrower. Again, discount points are always relating to getting it maybe a lower interest rate, depending on how much money you pay up front. So the idea there is if you're going to be paying over 30 years, a higher interest rate, or maybe you're going to be paying 30 years at a lower interest rate, but you got to put in some of that money up front to get that lower rate. The last point I wanted to talk about was this idea of different types of loans. So I'm going to go off the idea of cost of credit. And this aligns a little bit more specifically with the interest rates that we're talking about. So the amortization, this is called a fixed rate. I next want to talk, this is a little bit different than my notes. So give me a quick second to jot this down and process out loud. The interest rate with a fixed interest rate, usually it's 30, but it can be 15. When people have a lot of equity and your property values go up over time, you can maybe afford to get a 15-year fixed, which gives you a lower interest rate, which you'd think makes a lower payment, right? But because it's over 15 years instead of 30, your payment amount is higher, but it's paid off faster. So this just really comes down to preference and how you want to manage your money, what you can afford to pay. Another way to borrow money to purchase real estate is done in an adjustable rate. So here's fixed, here's adjustable. Now these are less popular, but when I was full-time in real estate leading up to the last recession, so in 04, 05, 06, 07, as that market was going nuts, adjustable rates became very popular because you could get into that loan with a lower rate in the front. And then maybe it's fixed at that low rate for 5 years, but then it adjusts. And that adjustment is then fluid for the last 25 years of the loan or until you pay it off, which could be by selling or by refinancing. So the adjustable rate is another valid way to buy loans, but it's a little bit less popular. People usually like that fixed 30 years because it gives you stability. You know exactly what your monthly payment is, and your interest rate, it's all fixed for the next 30 years. Everybody has different goals though. I knew investors that would buy a property and they would sell it within 5 years. They'd go in, they'd fix it up. Maybe they'd sell it in 2 years. And so they didn't care about a 30-year fix. They wanted the lowest possible rate for the lowest possible payment, even if it was for a couple of years only. For most people buying their homes, they might be thinking long-term. And so they're thinking, well, in 30 years, I want to have it paid off for when I retire, or over 30 years, that's giving me the lowest possible payment, but the most stability, the regular payments for 30 years. The adjustable rate has some sort of index that it's tied to. So here's a picture of an index. And that index could be, and sorry if this is getting too small. Let me zoom in a little bit. Oh, I'm already zoomed in. Oh, no, there we go. That index could be the prime rate, the London, it's called the LIBOR. Pretty much anything could be an index. And the bank says, here's an index that we're going to follow. And whatever that index does, we're going to give you 3% on top of that index, right? So that whatever this index does, your payment is going to mimic that index. So here's your actual payment amount on top of that. So it could go up every 6 months, every year, every month. It depends on what those terms are that you signed, that you promised in your promissory note. I've actually had one of these once. I had a 5-year fixed loan. It was an investment property. So I bought it, had my fixed payment for 5 years, and the end of that 5 years was coming up, and I'm thinking, I don't want to sell it. I have to refinance. But remember, every time you refinance, a bank is looking at your stuff, right? So your taxes, your credit score, your income, your debt, all that stuff comes into play. So don't just assume, oh, I'm going to be able to refinance in 10 years. Is the market going to be up or down? If the market's down, maybe you can't refinance because there's no equity. Maybe the market's up and you have a lot of equity, but do you actually, pass the bank's tests or whatever, right? For credit score, income, debt, and all that stuff. So don't just assume, well, I'm just going to refinance in 5 years. You don't know. So I was chugging along at my 5-year fixed payment, and it was okay, right? The property was making money. I'm good, but it was going to become adjustable. And I got really nervous, and I thought, what are my options? I have to refinance. What am I going to do? And what happened was, once it went adjustable, my rate actually dropped, and it dropped substantially. And it stayed low for like another 3 or 4 years after that. And so it actually could, it's a gamble, but it actually could even help you to do an adjustable rate mortgage. But again, there's no stability there, right? We're talking about every 6 months or a year, your payment changing. So most people buying homes don't usually go that route, but it is an option to purchase. Let me see where we're at. All right. So there is a little bit of overview of the cost of credit. Basically, that cost that you're going to have to pay to get that loan that you might need to buy the property. When you borrow that money, you're signing a promissory note, a promise to repay. And in that note, you are agreeing to certain terms like the interest rate, how long the loan is, whether or not you can subordinate, whether or not you can pay it off early. And then there's also information on that promissory note that is published, like the order of loans, of liens, the date, the amount when you got it, and the name of that lien holder. Hopefully that caught you up real quick there. All right. So here's all this stuff about finance that we're talking about, right? So why do we care? I'm going to be a real estate salesperson, not a finance broker, not a loan originator, which is a specific license. Why should I even care about all this stuff? Well, does this affect your business? And the answer is absolutely, this affects your business. If your borrower can't borrow money, then you're not going to close a transaction and you're not going to get paid. So step one, and this I'm really going to rely or tell you to rely on the training that you will get from your brokers when you start working in the industry. But for me, step number one, a buyer calls up and says, hey, Rick, I want to buy this property. And I say, well, buyer, how much are you pre-approved for? And they go, what do you mean? Well, how much money can you borrow? I don't know. Well, you need to talk to a bank. Oh, and by the way, how much money do you have for a down payment? I remember when I was a new agent, I was always so nervous as a new agent talking to people about finances. Like that simple question, how much money do you have for a down payment? When I'm talking to somebody on the phone or you meet somebody face to face, hey, nice to meet you. Hey, how much money do you have in the bank account? It's really awkward and it seems like really obtrusive, right? Like, hey, that's my business, not yours. But if I'm going to represent you and I'm going to be out there looking for properties for you, I have to know that you can actually buy those properties. And so one of the ways I used to frame it, again, rely on the training from your broker, but I would say things like, hey, buyer, how much money do you have for a down payment? Buyers don't like to answer that all the time. They say, oh, I've got enough. Oh, okay. Well, I'm glad to hear that. Well, like 10%, 20%? Yeah. 10%. Awesome, 10%. So what price range are we looking in? Are we looking at like $1 million properties? So 10% of that means you have 100,000 in the bank. Oh, well, I'm going to be borrowing some of that money. Oh, well, you know what? Have you talked to a lender yet? Because I know a lot of banks don't allow you to actually borrow the down payment. So what we're looking for is, if you have 50,000, then we can start looking for properties up to 500. Do you have 50 grand in the bank to put down? Right? Like if they aren't willing to tell me a dollar amount, I'm not going to be able to work with them. Right. This was when I was active in the market. Because at the end of the day, if they don't have the dollars, I'm going to spend all my time searching for properties and they're never going to close anything. I'm never going to get paid for that. So what's the point, right? This is my business. I can't just waste my time. But when you're beginning, when these types of questions might be, they might feel uncomfortable, or if you just don't know what questions to ask yet, it's very, very easy to put that responsibility on the buyer and onto a lender. So the one question is, have you been pre-approved? You don't need to ask about their credit score or their bank accounts or anything like that. Have you been pre-approved by a lender yet? If the answer is no, that is step number one. Do you have a lender? I can give you the name of a couple, or if you have a lender, please give them a call, and that will give us a really clear picture of what price range we can start looking in. Because I don't want to send you properties at 500 grand if you can really afford 700. Put it in that way, right? Usually it's the opposite is what happens, and the buyer's like, hey, send me properties $1 million down. Well, you can only buy 500. Why are we looking at $1 million properties? And so when they're pre-approved by that lender, now we actually have a hard and fast number that we can reference and look at. And if they can only afford 500 and all the properties around here are 900, you're going to have to figure out a way to not work with that client, because they're not going to make you money. And that might sound harsh. Maybe you can continue to send them properties automatically through an email system, but don't use your time when you could be working with somebody who can actually close a transaction. Again, this is your business, right? So if you're going to be losing money in your business, go work for free. If you want to make money in your business, you've got to find clients that have money that are able to purchase. So just a little bit of like real life right there. I hope you can appreciate that. So this is why you need to care as an agent about this stuff. Even though technically you're not a lender, you aren't talking to banks for your clients. Also, by the way, the knowledge of this information that we'll talk about tonight will help you as an investor yourself. I'm assuming most of you that are interested in real estate and you're thinking about doing this as a business, you probably want to buy your own real estate too, whether it be for an investment or your home. Also down the road, and I've never done this before, this is where I usually see a separation, right? People that do sales, that do real estate sales and represent other people as an agent usually don't dabble in the finance stuff, but you could. As a broker, you can actually make notes for other people or sell notes, so that way you're in essence acting as the bank for other people too. Again, that's up to your discretion. It's your business, right? Next up, so here's kind of the intro into this lending world, the promissory note, what you're promising with the bank, and the cost that it will cost you to get that loan. Next up, I want to talk about these terms called the primary and secondary market. Super interesting to learn about this if you don't know. Most people hear those terms, but don't really realize what it means either. So the primary market, which is also a term that we do not normally hear in the news. You may hear secondary market more commonly. So let's start with one you may have heard of. In the secondary market, there are a couple big names that are always referred to in the secondary market. Fannie and Freddie. Fannie Mae, Freddie Mac were organizations that were created a long, long time ago to create stability in real estate purchasing. Let's get there in a second. Let's now focus on the primary market. Now, in the real world, nobody ever says, oh, you're in the primary market. They don't talk like that. In the primary market is where we see new loans. Now, when you go get a new loan, do you call up Fannie Mae or Freddie Mac and say, hey, Fannie, Freddie, can I get a loan from you? You can't. In the primary market, where you have new loans being created, this is created between buyer and bank, right? You're going to go into your credit unions, your Citibank, your Wells Fargo, B of A, whatever banks you use, commercial banks, or you're talking to a broker on your behalf who's also going to help find you the best loan out there. In this primary market, what is created here, we've already talked about it, is called the note, the promissory note. Okay. So in the primary market, we have new loans being created, new notes being created. Now, the bank can give you $500,000 to let you go buy your house, but they then want to lend money to the next borrower who also wants 500,000. So either they have to have that in the vault, or they can borrow money to actually lend out, or maybe they have to sell your loan to get 500 back to then borrow or lend it to somebody else, right? So the bank has a couple options here. Very few banks anymore lend you money and hold on to that note for 30 years and just collect payments from you. Most banks create the note with you, maybe collect payments for a little while, but then maybe they sell that note to somewhere else to give them more money. That's where they make money. Some banks create money on origination fees, and they create new loans every day, all day. Bank and buyer, new loan, new loan, new loan, origination fee, origination fee, origination fee, sell off that loan right away and get our money back. Some banks specialize just in doing that and creating new loans, new notes. Some banks maybe are more strategic, or they have a different focus. They'll make a new loan, a new note. The buyer starts making payments. The bank sees that it's a quality buyer. They're making their payments on time, not missing any payments. And then they'll sell off that note and make more money on that note in the secondary market. So the secondary market comes into play with existing notes. So the bank has a couple options. They can hold the note, collect payments for 30 years, or more likely, they sell that note. I keep saying loan and note interchangeably. They are. The bank may sell that note into the secondary market. The secondary market then gives dollars back to the bank to then lend out to more borrowers. There's another, so Fannie, Freddie are big players here, and there are banks that live over here too that are buying up these notes and collecting payments over time. The bank has another option. They can lend you money for your purchase, keep that note, and then they borrow additional money to then lend back out to more borrowers. They borrow that additional money from the Fed. So when you hear in the news, the economy's going great, the Fed is keeping the interest rate at 1%, whatever it is. What are they talking about in that news? They're saying the Fed is keeping the interest rate at 1%. Does that mean that you, the borrower, get 1% interest rates? No. Who's borrowing money from the Fed? If you look at the diagram here, it shows you it's the bank. So when the Fed announces the Fed keeps interest rates low, 1%, that means the bank is borrowing that money at 1%. Then they turn around and lend it to you for 3%. The bank is making 2% on that loan. So why don't they just borrow money all day long and lend it out all day long? That's what they're doing. So one of the things the Fed does is they control interest rates. Again, not the interest rates to the general public, but they control the interest rates to the bank. They also manage or restrict the reserve requirements of banks. So the Fed could say, hey, the economy's going nuts. Prices are going up too fast. Inflation is going up too fast. We can increase interest rates to help offset that value and those prices going up. Because once the interest rate goes up, payments go up, prices will come down, right? This is like not the government that we think about as elected people, but it is related to the government, the Federal Reserve, the Fed. Or we can adjust reserve requirements. So instead of the bank having to keep only 10% of money of their money in the vault cash to give back to their customers. Let's adjust that. The banks now have to keep 20% in the vault, which means they can lend out less. So the Fed, in parentheses, the government, is involved in our everyday kind of access to dollars. And this is one of the tools that the government uses to help combat maybe an economy that's growing too quickly, or as we've seen in the last couple of years here, mid 2021, the Fed can actually lower that interest rate to allow people to borrow more money, which then stimulates the economy. We did not see this happening in 2008, which was the Great Recession. We had some recession with the pandemic, but it's been very small comparatively. The Great Recession, prices tanked for like 4 years, and not just prices. I'm talking about, interest rates were bad, prices were high, nobody had money. It was very, very challenging for several years. They called it the Great Recession because the Fed couldn't just lower interest rates. Because even with lower interest rates, people didn't have the money to borrow. So we were just stuck. It was a kind of interesting time. So what pushes all this? So if there's a flood of money, if the Fed is lending out money to the banks at such a low interest rate, all of the banks we see commercials for, right? You hear it on the radio. They say, or on, in between your shows on Hulu, or you're watching a movie on Netflix, and it's like, I guess Netflix doesn't have commercials. Pandora, YouTube, come borrow money, 2.99% interest. You're like, what? Because the banks are all competing with this 1%, right? I borrow the money at 1. Now I want to lend it out to you. All the banks are competing to try to get you to borrow money. Money also comes into the secondary market from investors. So think about when you put your money in a stock or a mutual fund, how much money do you want to make? How much return do you want to make? 10%, 15%, 20%? Yeah, I want to make as much as possible, right? So as we push money into the secondary market with investments, that also pushes money from the secondary market, right? From investors, from the secondary market into the banks, and then the banks go out to the buyers and they're like, hey, buyers, borrow money now. Hey, you refinanced 3 months ago, refinance again. We can even get you a lower rate. Hey, by the way, now you can even take out cash out of your equity. And right, it's like a big sales game because all this money is being flooded into the system. Banks are like giving loans away. And so for borrowers, it's a great opportunity. This is also where we've seen locally here in Southern California, prices go nuts. Prices have never been as high as they are today. Highest, in record ever right now. One of the things that has fueled that, one of it has been supply and demand, right? We just don't have thousands or hundreds of thousands of new units being built, homes or apartments or whatever being built in our county. There's a housing need, a housing shortage, supply and demand, basic economics. The other piece of that is the interest rates have still remained low. So you can still borrow money at 3%, 3.5% to buy a property. Super low, which means that your payment goes farther, right? You can afford to buy more because of that lower interest rate. So it's helped push prices up. Realize too, if you only know Southern California real estate, other areas of our country, other areas of our state do not experience what we experience here. I have plenty of friends now, especially now in the last couple of years, that have moved out of state or they have lived out of state for a long time. They do not see, we see some ups and downs and particularly high ups. Other areas of the country, some areas of California, are much more stable and take a lot longer to react to the market. A lot of what causes prices to go up in other states, like particularly 10 years, 12, 20 years ago, whatever, the growing last couple decades in Oregon and Washington, it's because people from California are moving up north because it was cheap. And now you have more and more Californians going north to buy properties, and those prices go up. Really popular states over the last year to 2 years has been Texas, Idaho. Those are two of the big ones. Arizona too. Prices have gone up there because people from California are now buying from other places, and it seems cheap there to us, right? Here we are with $900,000 homes. We can go buy a mansion in Idaho for, 500. Anyhow, if this is of interest to you, understanding this primary market, the secondary market, what happens in the secondary market, and how these funds from investors come in. When you hear the word finance, some people hate finance because they think it's about math. It's not about math. It's about how money is used. So finance for me has become more interesting as I've gotten older, because I've been interested to figure out how this world works in our nation with money, and how I can, use that knowledge to my benefit. Invest it, use it, borrow it, right? If we're talking about real estate here, how can I utilize other people's money to buy what I want to buy, or invest in what I want to invest in? Also, if this is of interest to you, a great documentary, if you've never heard of it, is called The Inside Job. Well, Inside Job. It's narrated. It's a documentary. It's narrated by Matt Damon. I don't know why, but it is. And it talks in depth about what was going on in the secondary market leading up to the Great Recession. There was another commercialized, much more like kind of Hollywood movie made about those times too, but much more inappropriate in a lot of ways. Inside Job is very professional. It's a documentary. A lot of interviews that they've done in the movie, and really interesting to listen to and watch. Again, if this sounds interesting to you at all, it's a big, and particularly with the recession that happened, the Great Recession in 2008, starting in 2008. Whoo! I told you, man, this is going to be a good class. Oh, one other thing, some real life, if I may. Again, there's a lot of real life in tonight's lecture, based off chapter 8, finance. There's a lot of options for you. When I say the word bank, I'm going to highlight it or circle it in red just to kind of, well, look at that. That's what I'm talking about. I'm talking about the banks. There's a lot of different banks that we can use. And a lot of times what we think about as a bank, we might think that's the only option. We hear a lot of commercials. Yeah, commercials. I do mean commercials. We hear a lot of commercials, and we see billboards on the freeway that talk about commercial banks. This is your Wells Fargo, B of A, all of the big banks. Okay. So commercial banks, we know about them. We hear about them. We hear commercial. Capital One. They've got their commercials are all over the place, right? And they make loans. So we hear about these commercial banks all the time because these commercial banks, it's their business to bring you in as a customer. Checking, savings, investment, mutual funds, real estate loans, car loans, personal loans, credit cards. They want to bring you in and give you all their products, right? Spend their money. I've used commercial banks over the years, and I particularly had some bad experiences with a commercial bank when I was in college. And I don't want to go into what happened, but I'm sure you've had bad experiences with commercial banks too. But it was that thing for me in college that was the catalyst where I was like, wait, I don't want to use that bank anymore. They were rude and not nice to me. They didn't help me out when I needed it. And I know they got to make money, right? But I particularly had an issue with fees that were involved. And they just killed me on fees. And then because of the fees, your balance is low. So then you get another fee. And then you go negative, and then you get another fee. And then it's like you get feed to death with commercial banks. That was my experience. But they have a lot of products. Commercial banks is one way to borrow money for real estate. Another one that a lot of people don't know about is called credit unions. Now, real quick question for you. A commercial bank, if you use a commercial bank, there's no benefit to me if you switch or not. If you continue to use your B of A or Wells Fargo, good for you. It doesn't matter to me. But let's think about the corporation. When Wells Fargo or B of A or Citi or anybody else, and by the way, I have accounts at some of these banks. Not my primary bank, but I still, borrow money from multiple banks. When the company makes a decision on what to do, are they going to be concerned about little Rick Boone, one little customer? Are they going to be worried about the thousands or millions of other customers? Are they going to be worried about their stock price? Because when they're making a decision and that brings the stock price down, investors go away, which means there's less money. And from what I've seen in commercial banks, there's history here. We've seen banks do crazy stuff, and some of them are talked about in this documentary called Inside Job, where they're actually defrauding the public and they're defrauding their own customers to make better stock prices and make more money as a corporation. On the flip side of this is a credit union. A credit union is not publicly traded. It's not a company. It's actually more similar to a nonprofit in that the customers of the credit union are actually the owners of that credit union. Now, it's kind of an interesting concept, but the idea of the credit union started with the idea of a group of people coming together and basically becoming a bank together. That is what a credit union is. So I love credit unions. I love my credit union. I've been there for over 20 years. And I joined up very soon after I got married, actually. And because of that relationship with the credit union, I know, and from what I've seen, they give the better interest rates when you're borrowing money and better interest rates when you're investing, like in a savings account or CD or something like that. And I know that they're making decisions that are based on my needs as the customer, because if I don't like it, I leave, the bank goes away. Like if the customers leave the bank, the credit union goes away. So it's a benefit to that bank, the credit union, to make decisions to keep the members happy. If you haven't used a credit union before, you've never looked into it. In the past, you had to be part of a special kind of population. Like there was a military credit union, you had to be in the military. There was a firefighter credit union, you had to be a firefighter to be in that credit union. There's a teacher's credit union, you had to be a teacher. But there's a lot of credit unions now that have been more broad. I know locally there's Orange County Credit Union. You don't have to be anything. You could just walk in and become a member of that credit union. Now, the downside, credit unions are usually a little bit more conservative, right? When they lose money as a credit union, that means their members lose money. So they're going to be more careful. They also might not have the breadth of services that a commercial bank might have. Like my credit union doesn't do any type of business banking. They only do personal banking, right? Where you go into a commercial bank and they want your business. All that to say, if you haven't looked up credit unions before, check them out. Another type of lender is called a mortgage company. I'm just going to throw out a couple more terms and then private lending too. So I don't want to dive in too deep here, but the big ones that I've already talked about, the commercial banks or the large commercial banks that you all know the names of. Credit unions, another great way to borrow money for real estate. But there's also other creative ways, like even private lending, where you can get money from individual people, usually at a much higher interest rate, but it's possible. Whoo. All right, if you want to take a pause, you can like pause the recording right now and then go get a drink, coffee or something. I'll share that with you. All right, let's talk about the loan process. Again, if you've never purchased property yourself, you're new to the industry and you're not a lender, so you may not even know how this process works. I'm going to give kind of some general steps here to the loan process to give you an idea of what it involves. To be honest with you, I don't remember how in depth the book goes here, but I know this will help your understanding. There's two different terms that buyers or lenders over the years have used with the idea that we're going to pre-qualify, approve a buyer. Now, these days, when the market has been hot for 2 years, a seller only wants to see that a buyer has been pre-approved, which means that the bank has my social security number, has run my credit, they've got my bank statements, they've got my paycheck stubs, they've got everything they need, and they say Rick Boone is solid. That's what sellers want to see. And so in parentheses, I'm going to write this word called a pre-qualification. A pre-qualification means you talk to somebody on the phone and you told them how much money you make. You told them what your credit score is, but they don't have any of your paperwork. These pre-qual letters, for the most part, are not worth the paper they're written on because the bank doesn't have your stuff. And we don't know if you can actually borrow money until the bank has your stuff. What we really want to see here, and especially in these days, what sellers really want to see is the pre-approval. And again, as a good agent, this is what you're telling your buyers to get. Hey, buyer, have you been pre-approved by a bank yet? Let's make sure we know how much you can borrow before we start looking at properties. I don't want to waste your time. I don't want to be sending you properties that you can't qualify for or that are too low for you. Let's get you pre-approved first. And if the buyer is not willing to run their credit, send in paycheck stubs and tax returns to a bank, well, they're not a very serious buyer. And you can tell them that. Hey, buyer, when we send in your offer, when it comes time, we find that perfect property for you and we send that offer over, we have to have a pre-approval letter from the bank. That's what we need to have. So some banks might take this and give you a pre-approval letter with pulling a credit score and looking at your income statements. But most banks are going to want you to fill out some sort of loan application. And so this is where buyers come at different ways. Okay, so as a buyer, I don't want to be sending my paperwork out to 30 different banks. I don't want to do it to 3 different banks. It's such a pain to have to talk to a lender at Bank of America, at Citibank, at Wells Fargo, and I'm sending paperwork to 3 different places. One says no, one says yes, but one says this, too high interest rate. Like I'm managing all this stuff in addition to, you know, my job and my family and, oh wait, whoever has time to sleep anyway. And right, like that's craziness. Oh, and by the way, the actual property that I'm trying to buy, right, that's a whole separate process from this. Most banks want you to have that application in. So another way to do this whole loan thing, instead of doing this with multiple banks, maybe multiple credit unions, is if you have a credit union or you have a broker, right? Like, so I might call my credit union because I've done a lot of business with them and say, hey, credit union, do you have any loans at 80% loan to value? Do you have any loans? Can I get a HELOC, a home equity line of credit? Do you have that product available? They may not. Credit union, can you lend money on an investment property, not my primary residence? They may not. So I might call my credit union because I know they're going to have great prices, but I'm going to rely a lot on a broker personally. Because I call up Joe Soto, great guy. Oh my goodness, it just keeps getting worse as I'm trying to write this word broker. Joe Soto, he's now a friend. He helped me buy my current home and I was stuck. He helped me get a loan when nobody else could help me. And I've used him for every loan, almost every loan since. And so when you have somebody that you trust and you know is looking out for you, and I only have to send all my stuff to one person, and maybe I'm sending my stuff to Joe one time and he's doing 2 or 3 loans for me with that one set of documentation. Oh, it's so nice to have that level of customer service. Joe, the broker, is self-employed and makes a commission on every loan he closes. Just like in sales, as a salesperson, you make a commission on every sale you close. So he's also motivated, the broker is also motivated to find me a great deal, because when he does, and I sign those loan documents and we close, he's going to get paid it from that. And he does a great job and he knows I'm going to come back. So it's that customer service piece that you don't always get at a commercial bank, or maybe not even at a credit union. So we have the pre-approval. Sometimes at the same time, we also have to do a loan application. After the application, we have to also identify that the property that you're buying, right? So we have the property piece of this. After all of your stuff, the application and all the paperwork is in for you, and all the paperwork and stuff is in for the property and the purchase contract, then all this paper comes in and it goes into underwriting. Underwriting has a couple of steps, but one of the things that they do is they confirm everything that you just gave them. Like they check with the IRS and they say, hey, IRS, does this match what you have? This is what the buyer just sent us. Are we matchy? Are we good? Maybe they go back and check your paycheck stubs. They go back and check your credit score again. They confirm a bunch of stuff. They also have to go through and make sure that the property is qualified. Did the appraisal come through? Is there termite issues? Is there construction issues that have to be fixed? All of that stuff has to filter through the loan process because the bank doesn't want to lend money for a property if the property is broken. They just don't. So we have this process that goes on. Underwriting may come back and say, oh, hey, we need more information. We need more paycheck stubs. We need more down payment. We need more paperwork on the property. What if it takes a week or 2 weeks? Then we go into the next month. Then it goes back into underwriting, and underwriting says, hey, we need another month of your bank statements. We need another paycheck stub because another month has passed, right? So sometimes this paperwork back and forth can take, this is what usually takes the 5, 6, 7 weeks of an escrow is because of the loan, typically. In the application, I want to point out some things that the bank needs from you. First one, and I don't want to say it's the most important, because these 3 things, maybe you have great credit and great income, but you have a lot of debt. Maybe you have not so great credit, but you have great income and no debt, right? So these 3 things can play interchangeably, but almost the first qualifier that the bank uses is your credit. And I call it the credit game. It is a game. When they run your credit score is going to dictate what rate you might qualify for. Maybe the bank sees your credit score and they say, oh, you're at 650. We can't even give you a loan. Maybe at 680, they give you, 4%. And when you hit 720, this is usually considered A paper at 720. You're going to get the best rates, maybe at 3, 3.5. Oh, wait. Well, let's just say you get up to 760, 780, 800 credit score. I mean, whoa, you're going to get the best deals for sure. And then, that rate might drop as well. This credit score thing is a game because you can actually have a lot of debt. But if that debt is less than 50% of your total available credit, your credit score can actually go up, even though you have a lot of debt. So there's a lot of free services out there these days. I use Experian, the free Experian tool that they have. Not totally accurate, but it lets me go in and I can check on my balances and to see what my banks are reporting out. And of course, protect against fraud and that kind of stuff. But Experian, I just do the free one. I don't pay anything for it. I do the Experian. I don't even know what it's called, what their app is called, but I can go in there and look at all my balances. I get an idea of what my credit score is doing. And what's funny is that Experian will send me an email and it says, hey, Rick, want to increase your credit score? Go get another credit card. I'm like, what? The credit game. Because what they're saying is if you can get a credit card that lets you borrow $2,000, round numbers, don't actually borrow $2,000, but the credit line shows that you can. Here you have a big credit availability, borrowability, credit lines, but your debt looks smaller now because of this extra credit. That actually helps your credit score. It does not help your credit score if you have 12 credit lines, though. It does not help your credit score when all of those credit lines are new. So the credit game is, you might think you're making smart financial sense. My daughter, she has become so responsible. She'll put dinner on the credit card, on her credit card. Then she gets home and she pays off the credit card before the charge from the restaurant actually hits the card. So she'll have a negative balance on the card. If that does not help her credit. If every month the credit card reports that you have $0, that shows the credit reporting companies that you don't know how to use credit, right? It shows that you're not using credit. It shows 0. So the best way to build your credit, if you have no credit or if you have low credit, is to try to keep your available credit, let's just say your total credit cards, gas cards, retail store cards, right, from the mall or wherever else. If you have $10,000 using round numbers, you want to keep your balance that's reporting at about $2,000, about 20%. That's going to be like a maximizing your credit score. So here's the game. Do you want to pay 30% interest on $2,000? Heck no, right? So you have to play this game where you're paying off your credit card, ideally, so that you're not being charged interest. But you want to be able to know when your bank is reporting that balance to the credit agencies. So here's the ideal. My bank payment is due on the 5th, and I know that my credit card is reporting the balance at the end of the month. And so that gives me a couple-day window. So the bank says, hey, credit bureaus, Rick has 20% debt to the credit line. And the credit bureaus go, good job, Rick, you're using your credit responsibly. And then by the 5th, I pay the balance off so that I don't have to pay interest on that debt. Quick tip. I don't have enough time right now. We could probably talk about this for a whole hour, talking about credit scores and stuff. I'm sure these days too, with these different tools, Credit Karma, Experian, you can find a bunch of stuff online that can give you some more insights. The last couple of years, the credit score and how that system works has been much more transparent. Ironically, you can have debt and still have a better credit score, which is it's just kind of interesting, right? So coming back, taking a step back, your application with the bank requires these 3 things. One of them is credit. Ideally, if I was going to say one's the most important, it's going to be the credit. Although, again, these 3 things work together. The next one is called income. At the end of the day, the bank has to see that you can make your payments on this loan. They also want to see that you can make this payment and continue to buy food for yourselves and gas and clothes. So they want this payment to be lower than a certain percentage of your income. This is where, in California, it gets tough because our rent, our loans are super expensive here because prices are high. We have to show that we can make this payment and that payment isn't, half of your income. We show this income in 2 different ways. One is called W-2s, right? Your tax forms, and they want to see 2 years of those tax documents. So if you're looking to buy a property in 2 years from now, you have to be paying attention to what you're filing on your taxes this year. Because at the end of 2021, then 2022, then maybe you're going to buy something in 23. They go back 2 years on those W-2s. And if they see crazy income, then there's going to be problems. I mean, if you're making more money, that's not necessarily a bad thing, but they might actually average out the 2 years. The other part of your income is your pay stubs. Oh, also with the W-2s, if you own your own business and you write off all of your expenses and it shows that you make $0, That's great for your tax situation, right? To not have to pay taxes. Nobody loves paying taxes. People usually don't love paying taxes. If you write off everything and you show no dollars, that's no tax, right? But if you show no dollars on your W-2 and you give that to the bank, they're going to say, well, you made no money. We can't give you a loan if you don't make any money. Oh, but my paycheck stub says I make $1 million. Yeah, but all of your business expenses are $1 million. So they use the W-2s as a history, like a 2-year history. And then they use the paycheck stubs more as a year to date. And they usually look at those for the last 2 months, at least. So, oh, you made that last year. Well, what have you made so far this year? Give me your 2 most recent paycheck stubs. The other big factor when it comes into loans is called the debt to income ratio. This is a little bit more, I don't think the book goes this deep, but more for you. This debt to income ratio says today, your credit cards, your student loans, your car payments, all of that debt can only be 30% of your income. Just giving you an example. And after this new purchase, we don't want your credit cards and your school loans and your car payment plus new real estate loan. We want it to be at 45% or lower. A lot of banks say at 50% debt to income, we will not lend to you. Which again, in California, can be a problem. Right here. When that mortgage payment is so high, it takes up so much of your income every month, the bank might have a problem with that. Now, the bank has control over this. The bank can adjust these debt to income requirements. Every bank is different. This is where I love having a broker, because this is some of those details that I just don't have the time to try to shop for every loan for every bank whenever I need to borrow money. Then, of course, one of the things you have to show and you have to have for that loan. So if you're looking out 2 years from now and you say, I want to buy real estate, these are the things you have to start paying attention to. If your credit's like, okay, how can you get it better? Because a higher credit score means lower interest rate. Lower interest rate means lower payment, which means lower back-end debt to income ratio. How much money can I save over the next 2 years? Because if I increase my down payment, I have to borrow less, which means a lower payment, which means a lower back-end ratio, right? You see where I'm going? So these things are all kind of intertwined together. But if one of them is off, it could be that the other ones offset it, right? So that they're all in play here together with the loan. I hope your brain is not exploding yet. This is all like super important, but great information to have. And maybe you've never gotten it like this before, because I don't know any other classes that you can just take to learn this stuff. You can take a real estate finance, I guess. But this is like some real world stuff that we're talking about here. Another thing that comes up when we're talking about finance is the downside to finance when you get in trouble, the foreclosure. I think I warned you up front this was going to be a longer chapter. Solid hour, maybe a little bit more here. Foreclosure. When you borrow that money, when you sign that promissory note and you promise to the bank that you're going to make that payment, what happens if you just can't make the payment? The answer is the foreclosure. This is when you break your promise. Right? You can't make your payments anymore. To try to encapsulate the foreclosure process, I'm going to do a really quick step. I don't want to call it an analysis. Some real quick steps of foreclosure, just so you can see in one place how the process works. In the foreclosure process, what kicks off the action of foreclosure is having 2 late payments. So let's just say your payment is due on the 1st. And then on the 10th, it's late. On the 15th, you get charged a late fee. Okay. So 2 late payments. At 2 late payments, the bank files a form, goes in public record, called a notice of default. They say, hey, you broke your promise. You've had 2 late payments. Notice of default comes in the mail, registered, gets published, County Courthouse, and I think they stick it on your door too, which sounds crazy, right? But somebody comes out and sticks it on your door. I'm gonna do this in a timeline as well. So let's see, what month are we in right now? June. I'm just gonna call this June 1. Your payment's due July 1. Your next payment's due, right? On June 31st, we have this thing called a 30-day late. This 30-day late hits your credit score. That 30-day late will stay on your credit score for 7 years. If you can avoid being 30-day late, try to, right? So on the 1st it's due, on the 10th it's late, on the 15th you've got extra fees. If you can make that payment on the 30th, try, please try, because on the 1st, again, this is when it's reporting out 30-day late. It's ding on your credit right away. So here's missed, I'm sorry, we have the, I'm gonna call it the 10th. We have this 10th date that says, oh, you're late number 1. July 1st hits, you're 30 days late. July 10th hits, oh, late number 2. Notice of default. You have broken your promise. By law, the foreclosure process with our trust deeds says that over the next 3 months, the process continues, but the bank has to allow you time basically to make things right. We call this a reinstatement period. If you can bring current your payments, right? Then we reinstate the loan. This goes away. But the problem is, after you miss payment number 1, and then you miss payment number 2, payment number 1, fee, payment number 2, fee, this notice of default kicks off our 3-month window. So here we are, July 10th, then we hit August 10th, then we hit September 10th, 1, 2, then we hit October 10th. Uh-oh. 3 months goes up. The bank says, you broke your promise, and we gave you a notice of default. We gave you 3 months, and now we are issuing a notice of sale. We've given you 3 months, and we're going to sell your property. Now, mind you, if you can bring current your loan at this point, you have a bunch of late payments, missed payments, and your credit score is tanking because you've got a 30-day late, you've got a 60-day late, you've got a 90-day late, you've got a 120-day late. Each one of those is affecting your credit. You're getting nailed on your credit score. We've got 1 payment, we've got 2 payment, we've got 3 payment, we've got 4 payments, we got 5 payments that are missed. Plus fees every month for those. Plus, since the foreclosure was started, you've got fees to the trustor as well. Trustee, sorry. The trustee. The trustee is that third party that's handling this whole process. So 5 payments. Do the quick math on that. It's tough to come out of this if you're stuck in it. 3 months passes, we have a notice of sale. The next kind of requirement in the foreclosure laws require that the bank advertise for at least 3 weeks. So they say a notice of sale in 3 weeks, we are going to sell this property. Advertise week 1, advertise week 2, advertise week 3, sale. So here we are in October 10th, and I'm using some rough numbers here, right? But we're talking about, by the first week of November, you're losing the property pretty quick, right? So the bank knows if you stop making your payments after that second late payment and the notice of default is filed, basically they can take back the property, sell it, or take it back in 3 months and 3 weeks. This gives you, the borrower, though, a minimum window to be able to bring this loan current if possible. This is the fastest the bank can do it. You may have heard stories in the news or friends, especially during the last recession, where the bank, you heard somebody say, "Oh yeah, I haven't made a payment to the bank in 2 years and I'm still living here." Okay, that's not normal, but it could technically potentially happen. This is the fastest that the bank can go through the foreclosure process. The law does not require the bank to actually foreclose. So maybe they go through all of this and then they push off that sale over and over again because for whatever reason, the bank does not want to sell or own that property back. Not yet. I'm sure they want their money, but not yet. So this is the fastest way that the foreclosure process can happen. But there are some alternatives as well. Because the bank is usually in the business of lending money and making money on that money, right? They are not in the property management business. They are not in the real estate investment business. They are not in the rehab or construction or, flip this house business. So most of the time, banks don't really want to own a bunch of property, single family homes. They would much rather get their money back if possible. So there's some alternatives. Here we are mid-2021. The government has put a stay on all of this stuff during the pandemic. So we haven't seen any waves of foreclosures happening yet. But I've heard economists or I've heard people say that they're waiting for it. Investors are waiting for it. Not to say that it's exciting and it's good, because people are losing their homes through all of this, right? It's not good. But the idea is that people, if they haven't been making their payments for the last year, at some point, the bank is going to want to be able to get their money back for that property. There are some alternatives. The bank can say, instead of us selling the property or taking the property back and then having to resell it ourselves, let's change your existing loan. It's called a loan modification. And so the bank might say, hey, you paid for 10 years on this loan and then something went wrong. Let's bump your payments out and redo your loan for another 30 years and kind of like give you a do-over. Now your credit is wrecked. You've got how many missed payments? 6 missed payments. So that's a lot of money that you still owe the bank. But the bank could kind of wrap that all up together and then in essence let you borrow that money again if you can show that you can make those payments. Another option that the bank might say is we are in foreclosure, but we won't actually sell the property yet if you can sell it first. Because let's think about this real world. If you're a buyer and looking at a property, you would much rather buy that property from a seller who's selling the property, as opposed to the seller losing the property to the bank, the house sitting empty. Nobody knows the history at that point. Now the bank tries to sell it in the open market. And the buyer coming in, maybe it's a lower price, but you don't have any knowledge of the property. You don't know what's going on. There's no warranty or anything on that property when you buy it. The bank may allow the seller to sell it. The bank may allow the owner / borrower to sell the property before the foreclosure finalizes. There's another term called a short sale. This is that same scenario, except in the short sale, the bank is losing money. So I owe the bank 500 grand, but the house is only worth 400. Since the bank is losing money, the bank has to approve that. But in most cases, the bank would still rather sell it at a loss than take the property back, have it go vacant and not cared for, and then still lose money at the end of the day. This was happening a lot after the last recession, 2009, 10, when the market was horrible. Prices were down. Investors or homeowners that could borrow money were picking up short sales. There's also a term called a deed in lieu of foreclosure, the big F, right? Deed in lieu of foreclosure says, basically the bank says, hey, borrower, owner, you can't make your payments. Instead of us waiting 6-7 months and your credit getting all messed up and then us having to kick you out and then fees and blah, 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 and all this bad stuff, right? Instead of going through all of that process, just deed us the property back. The owner can sign the deed, give it back to the bank. That is possible. The bank has to accept that though, and it's not too common, especially here in California, Southern California. It's a legal option, but not normal. All right, so hopefully that gives you a little bit of insight into foreclosure, kind of the process that we covered here, kind of in a step-by-step, 1, 2, 3 type process. But hopefully this timeline that I ran through also gives you a clear picture of what those steps look like kind of in real world. So the big number in there, basically the foreclosure can happen as quick as 3 months and 3 weeks from the notice of default. The notice of default is the first actual step in the foreclosure process. Well, there's one other section that your chapter talks about. I'm not going to talk much about it, going over disclosures. Disclosures are a big part of lending. They're a big part of being a salesperson as well. The big one in lending is called the TRID. Again, I'm not going to talk about it because it's in your book. But the big part about this is that it allows the buyer, even after signing the documents, it allows the buyer 3 days to back out. It's about disclosure and informing the buyer of what they're getting into. Those laws have changed a lot over the last 10 years, really making sure that buyers understand what they're committing to when they sign those docs. And even when they sign the loan docs, they still give you a 3-day window to back out, just in case there's, alarms go off or something happens. And so I don't want to go too deep into it because I'm not a lender. And the disclosures and all that, and actually for you all taking this class in principles and watching this video about chapter 8, I don't want you to go through and actually try to memorize all the disclosures. I would much rather you read through them, go over the overview of these disclosures, but don't feel like you have to memorize. We're talking about one chapter within the principles. It's a couple pebbles in this foundation of real estate, and having a grasp on this overall concepts of finance is much more important for your salesperson's license and for your exams than really memorizing the disclosures, especially since you're not going to be lenders, right? And if you are going to be lenders, if that is of interest to you, you'll be taking further classes and further licensing. So for the sake of this class and this license, I don't want you to spend too much time and effort on the disclosures. Hopefully you're like, woohoo, less reading. Yeah, hopefully that helps you out. So thank you for being here and learning about finance with me and through chapter 8. There's a lot of notes we went through tonight, but super informative information and real life information coming out of this chapter. If you're not reading it that way, hopefully this lecture helped you really pick up on the kind of like insight and personal help you can get from knowing this information. Stop sharing here. Thank you for being here tonight. I know it got late. Appreciate you taking the class, and I hope you all well. I'll stay on for a few minutes here to answer any additional questions. Thanks so much.